Hello, and thank you for joining this short video on valuing your business and why it matters. Business value is like a scorecard for your business. It helps us understand how management is doing. If your leadership team is rapidly growing the enterprise value of your business, they're probably doing a really good job. And it's also important to other parties like potential investors and, of course, the sellers who want to realize some value from the sale of your business. And employees and customers are invested in the success of your business too. So business valuation affects lots of people. Now, how do we go about valuing our business? The first thing is to really organize our business affairs well. This includes ensuring we have up-to-date financial statements so we can properly understand the current and past performance of our business and the assets and debt that we hold in the business. It's not just the financial affairs, it's also the legal affairs. Which entities exactly are we valuing here and who owns them? And are they compliant with local laws? Are they properly registered and are they properly licensed? Getting all of this right is a really important first step in business valuation. And that leads us to methods of valuation. Now, in some industries, there are norms or typical ways of valuing businesses. We see among manufacturers, for example, net asset value tends to be important. Other industries or business models like multiples of revenue, multiples of profit, discounted cash flow methods, and so on. So it may be that the answer lies in the particular business model of your business or the industry in which you operate. But sometimes we look at comparable transactions. That means other sales which have occurred with businesses which look something like us in terms of size, in terms of market, in terms of industry, and so on. These might be private transactions, in which case it's difficult to get the financial data on those transactions. We might then look at publicly traded entities where we can get a lot of financial information and understand how those businesses were valued. So comparables is another way of arguing the value of your business. Now, sometimes as a seller, you may say, I have a particular amount I want to make, or I have a particular return on investment that I want. And here's a simple formula that you might consider. Let's say we know the annual profit of your business last year, and we divide that by your proposed return on investment. It might be 50%, 60%. Multiply that by 100, and we can get the minimum amount that you need to achieve from the sale of your business in order to get that return on investment. You then have to persuade a buyer to pay you that much, and that will be an interesting conversation. Let's continue with some valuation methods. We talked about net asset value, where we take all of our assets, tangible and intangible assets like goodwill, intellectual property, and so on, and we subtract our liabilities. This can get complex. We also need to consider depreciation of our assets and any other debt that we've taken on. But this arrives at a net asset value, which is a very good indicator for asset-rich businesses. And here's an interesting way to think about the value of your business. What would it take someone else to recreate your business from scratch? And how long would it take them, importantly? Because what you're really offering is the fact that they don't have to go and recreate your business from scratch. They get it in a box, and they don't have to wait for it. They can enjoy the benefits of your business, perhaps the profit, the growth, and so on immediately. So if we can model the costs of recreating the business, we can get a pretty good indicator of business valuation. Now, we can look backwards or at the current state of our business to find clues on valuation, but most investors will be interested in how your business is likely to perform in the future. And this is based on some really important questions about your market. Is it growing? Is it big? Is it competitive? Who are the customers? And what products exactly are you going to offer into that market and at what price? And who is going to drive the success of the business? Who's making the products? Who's marketing them? Who's selling them? And then we can generate some forecasts for sales, how much we are going to sell in what time frame, and our expenses. What is it going to cost to keep the business afloat? And based on all of that information, we can estimate the return on investment and arrive at valuation. Now, remember, these methodologies are all just guides, because the best indicator of value is what an actual buyer is willing to pay. And there are many instances where one of these methodologies gives a certain number and someone pays 3 times that. Conversely, we have situations where a methodology generates a certain number and no one will pay anything like that number. At the end of the day, it's what an actual buyer is willing to pay for your business. And that means we really need to understand what's driving the buyer to proceed with this transaction. I hope that's helpful when you consider valuing your business, and grateful for your time joining our video today. Bye.